Disney sliding almost 3% after reporting mixed third-quarter results this morning. Earnings topping expectations, but revenue missed slightly. The media giant did see growth in its streaming business, and its ESPN yesterday announced a major NFL network deal. For more, let's bring in media executive Tom Rogers. Tom is a CNBC contributor and a senior advisor to Versant, which will soon become CNBC's parent company. Tom, great to see you.
Great to be on the same team with you guys.
We're always on the same team, right? Just formally once again. Back to Disney, though. This is a story that you had been getting more bullish on, but now this quarter concerns you?
Yeah, I would say you can't take anything away from this NFL deal. This is great for ESPN. I think it will really help the streaming service. One caveat, I had hoped that Red Zone was going to be part of the streaming service because I thought that would really help with younger demographics in terms of the standalone ESPN streaming service. That's not part of the deal. It's an upgrade pay. Other than that, this is really good for the sports side of the equation. I think the trouble here is you can say streaming grew, but it was really modest. It looks like subs on both Hulu and Disney Plus are pretty stalled, certainly compared to Netflix sub growth. And when it comes to advertising, it looks like they were flat to a slight decline when it comes to the streaming side of the equation. That gives me pause. That should be the growth asset of this company, and it's hard to put growth against that with those kind of numbers.
Although my feelings have not changed in the slightest, I think now that Tom is a senior advisor to Versant, I should probably shelve the stud moniker for the time being.
What are you talking about? I
don't want to get him in trouble with his comrades.
He wants stud. He just
well, you're a stud. There you go.
Stud now.
Senior stud. But with that said, you also were sort of skeptical at Netflix a couple weeks ago, correctly so, because the stock had not seen an uptick until today. My question is, does the Disney earnings release give the green light to get back into Netflix?
Well, Netflix results are much stronger. I think both of them not giving information anymore on subs is really misguided. You could understand Netflix saying that it wasn't going to give guidance on subs anymore because it's gotten to a point where you could argue that's less relevant. Disney, with the kind of sub growth it is showing here, far less sub growth than Netflix. It really shouldn't be in a position here of taking away that degree of transparency. And I don't even understand it. Advertisers have to know how many subs they're reaching on the ad tier. You can't say an advertiser, sorry, we're not going to tell you. If advertisers know, the world's going to know that number. And unless they stop giving the percentage of new subs that are on the ad side versus the non-ad side, going to be able to figure it out. But yes, I think overall, where the two are today, Netflix is comparatively in a much better position. Having said that, got to give Disney kudos. It's got more streaming revenue than linear revenue at this point. It's got almost half of its viewing coming from the streaming side, totally different from any other legacy company. And between Hulu and Disney Plus, they do have the most ad revenue of any streaming service. So, you can't say they haven't built something there that's there to last. It's just not growing at this point the way it should.
But yet, if Disney's having problems, Tom, and its path has not been linear, this trajectory, that is, what does it tell you about the other streaming services?
Everybody has some growth pains here that I think show that being in the streaming business is not easy. I think they're attacking it by cutting back on costs to increase profitability. I was surprised that the CFO said that they weren't looking to put any more money into domestic programming. And everybody's been hit with higher sports costs. The sports cost strain is causing less money to go into entertainment programming, but they need more entertainment programming. It's that volume that really drives engagement, which is what Netflix has been able to profit from. So I think they're caught in a bit of a difficult position here between right-sizing expenditures.